Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and we're going to start with our inaugural edition of Fundamental Fridays. So we put together an entire round of investing from videos from options 101 all the way up to options 104, giving you the basics of options and how you want to dip your toe in the water if you're interested in option trading. Fundamental Friday is going to go along with that theme, and we're going to allow you to ask questions, and we're going to look at real trades using real numbers and do it in a very basic layman's way. And we're going to figure out, how to use options to enhance your portfolio of stocks. And so before we get too far along, I have to let you know that options involve risk. If you're going to trade options, you should read the characteristics and risks of standardized options. It is available throughout the Tradier website. And with that said, let's pull out and let's run over to the Tradier.com paper trading platform. And we're going to look at a trade today in Apple. We're going to look at trading as Apple. We're in the middle of earnings season. And because of that, we're going to use options as what they were first intended to be used as a way to protect an asset. In this case, we're going to talk about one of the most popular stocks in almost all brokerage accounts, one of the most widely held stocks at Tradier, Apple. AAPL. Apple is going to be announcing earnings on April 30th. And we talked at the end of the option trading roadmap, session 104, buying a put to be bearish on an underlying stock. Today, we're going to combine that put option that we talked about to the stock. And the way that I like to think of options as a basic option trader is, how can I use options to protect my portfolio as opposed to starting out my option trading roadmap by thinking of options as a way to leverage my account. And a lot of people think of options that way, and they think of the speculative nature of options. But ideally, options were, if you go all the way back to before there were listed stock option exchanges, options still existed. They're a contract, and those contracts were always meant to be used as a way to protect an asset. That asset might be, could be in commodities. It could be all the way back to the Dutch aristocracy, where they created options on tulip bulbs because that was the wild craze at that point in time. So with that said, our underlying is going to be Apple today. And I already went into the Tradier paper trading account on Tradier.com. And you can sign up for this account too along the way, and you can actually execute these trades as your step in the roadmap to learn how to trade options. So most of the time when I think of a protective put, I look at it as I own the underlying stock, and there's a known event, or just maybe something happened. Maybe the Bollinger Band ran into the Fibonacci and bounced off a moving average, and for some reason I'm a little bit nervous about the downside of an underlying stock. Now, to go along with this, I always say that if I'm buying a protective put, I'm still bullish on the underlying. I still want that stock to go up, and that's the best case scenario. If I was truly bearish on the underlying, what should I do? Just sell the stock, right? So it's going to get me through a rough patch. So as you see inside this paper trading account, we see that we already executed 100 shares of Apple, and we bought it today. Now, you might have had Apple in your account for quite some time. And like I said, it's one of the most widely held stocks throughout Tradier and all of Tradier's clients. So I think it's appropriate to look at Apple as it heads into earnings. It's a fairly expensive stock, $270 at this point in time. And the way that we're going to set it up is I'm going to show you how to, now that we've executed and bought the 100 shares of stock, let's go out and buy a put and let's protect ourselves as we go into that earnings date. Now, Apple is anticipated to announce earnings on April 30th after the close. So you got a little bit of time here before that earnings date. But I want to talk about by buying the protective put, how you are going to limit your risk on the downside and how that is going to work out. We'll then look at a profit and loss graph actually inside my website, optionsplaybook.com. And then we'll come back and actually execute that trade in the paper trading platform. And once again, if you open up an account, the paper trading platform is free to you. There's no cost to do it. And you can actually execute and follow along with every Fundamental Friday and actually ask questions of me during the show if you attend the shows live. So with that said, let's now go in and look at the option chains, and I'll talk about the strategy of what put to buy, how long we want to go out, and just give you a feel for how the option chains work. This is probably one of the most important pages for an option trader, is to be able to see all the option contracts that are available on a stock, and also see all the different expirations that are available. And we'll talk a lot about the strike price that we're going to choose. Okay, so let's go to chains. We're going to click on this. We're going to type in the underlying symbol. And once we click that, the chains pop up instantly. Now you can scroll up to the top. There's a little bit more information up on top. You see Apple, you see the weekly range, you see a little bit of a chart. And you see here that Apple, since the beginning of the year, we had some trials and tribulations as far as insurance was concerned. So I want to give a little bit of a background. But at this point in time, Apple has had a strong move. This is an intraday chart, but has had a strong move over the last couple of months to the upside. And we find it now even up today, 2.7%, a lot to do with what's going on in the market overall. It's dragging all the stocks up. But with that said, it's trading for $270. So this is a live quote. And I always want to emphasize that we're learning today. This is not meant to be a recommendation, right? But if I look at the chains, I'm going to go over here. This actually indicates how many option contracts you get to see, plus or minus 20. So if I'm going to go in here, we're only going to focus on things that are very close to where the underlying stock is at. So we're going to go 5 strikes up and 5 strikes down. Now, if that term is a term you haven't heard before, strikes, you want to go back and listen to the fundamentals. Actually, the 101 session covers all the vernacular of the options trading world. All right. So now if I look at the chain here, we have Apple stock. We know where that's at. You can look at the calls. You can look at the puts. My favorite is to just default to all, and that's where the chains start at. So on the left-hand side, we have calls. On the right-hand side, we have puts. It's highlighting that the stock is at 270. We'd call that the most at-the-money option contract. And if we also look at this, we want to go out beyond the earnings report, right? We want to go past that date. So in order to do that, we've set up the strikes. Now we want to look at the expiration date. So I'm going to click this down, and this is as of today, but I really like the format that Tradier has decided on for their chains, and that they're actually putting the date in here. They're not writing out April. They're just telling you this is the year and this is the date. And if you scroll down, it also highlights the days to expiration. Now, we know that April 30th is when that earnings report is. I'm going to go a little bit beyond. I'm going to go out to May 15th and go out 28 days. Now, when I'm buying a protected put, it's expensive. If you think of it as insurance, just in general on your house, the odds of your house burning down are a lot lower than the odds of Apple stock going down after earnings, right? So the premiums are going to be fairly expensive. And so that's important to understand that around earnings, you will have to pay a little bit more for protection because of that known event. But there are still times where it might apply. If you've owned Apple over the last couple of months, it wasn't that long ago that Apple was trading around $200. You'd be up about $70 on that $200 investment, and we'll pretend that we had 100 shares of it. So we're a little nervous about earnings, like what could happen after earnings. And stocks like Apple, and we've seen this recently, actually this morning, we saw Netflix announce earnings, real good earnings report, but the stock actually sold off. Why? Well, why not? It's an opportunity. Buy the rumor, sell the news. Even though it had a strong earnings report, the stock actually has dropped a little bit. Now, not saying that that's going to happen with Apple, but if you want, you can protect yourself against that drop. Okay, so with the stock right now, let's say it's at 270. We're going to hang out on the put side over here. We're going to ignore some of this data. We'll address that later on in Fundamental Fridays. But the strike price that we're going to look at is the 265 strike. Now, why is that? Well, if you think of, let's talk about car insurance this time around. Very rarely do people buy the zero deductible car insurance. And when I look at the strike price of a put option, and in particular, a protective put option, which is going to give me the right to put that stock at that strike price over the next, what was this, 28 days, which is the May 15th expiration. If I have that right to do that, a lot of people won't pay for the zero deductible because that's a fairly expensive one. So if we look at the zero deductible insurance going out 28 days, we're looking at paying right now on the ask price $7.90 or $790 to protect our 100 shares. But that allows us to put the stock at 270 to the person that actually sells us that put option. Or in the marketplace, you would exercise your contract and assign somebody on the other end and sell your stock at that price. But in order to get that right, it's going to cost you $790. Well, that's a little bit expensive on a percentage basis. So I'm going to say I'm going to take the $5 deductible. If the stock's at 270 and I buy the 265, I'll take that 5 points of risk down to 265. So it doesn't protect me, just like with your car insurance. If you ding a headlight, your insurance company's not going to pay for that to replace the headlight. But if you get in a major car accident, they might give you a new car in that instance. So that's what we're kind of looking for, is a protection on the downside, not on the minimal cost. So in this instance, we're going to buy the 265. That means that we're going to go 5 points down. And that represents on the stock 2.2%. So 5 points on a $270 stock is 2.2%. So that's my risk. That's my risk. And anywhere from that on down, all the way up until that expiration date, if the stock goes all the way down to 245, I can take it at 245 and put it to somebody at 265. I can do that. So my risk is that deductible, but also with your car insurance, you pay for your premium for your insurance up front, and that's a true cost, and that's got to be added in. They might give you a new car, but they don't say you are right, you're a horrible driver, here's your premium back that you paid for your policy, right? That doesn't happen in the options world either. So it's a cost of doing business. So I'm going to actually execute this trade, and we're going to protect our 100 shares of Apple going into that earnings report. So I'm going to click here and I'm going to click buy, and we're going to send this to the ticket. And when we send this to the ticket, we're going to have Apple, and it's going to highlight that it's a put, and we're buying to open one. And this is very important. If you're trading options, not like stocks, you almost always put a limit order in. And we're going to say, based off of where that market is at, we see that the midpoint for this option contract is $5.70. That is the valuation of this option contract. But we want to execute it. We might, if we weren't doing a show, we might try to work it a little bit, somewhere between the bid and the ask. But we're going to just put this on the limit price of where the market is at, $5.75. And of course, we're dealing with real markets, so it moved as soon as I clicked it. That always seems to happen. But with that said, we're going to look to send this to the trading floor. So we're going to pause for a quick break, and when we come back, we're going to actually send this position off, and we're going to have our Apple shares protected as we head into earnings.
If you've been watching this show thinking, this all sounds interesting, but how do I actually start? That's where Tradier comes in. Tradier is a brokerage platform built for traders who want professional level tools without the complicated barrier to entry. As a beginner, what matters most is simplicity, reliability, and cost efficiency. You don't want hidden fees, you don't want clunky software, and you definitely don't want to feel overwhelmed. Tradier gives you a clean trading interface, transparent pricing, access to stocks, ETFs, and options, and the flexibility to grow as your knowledge grows. What I like about Tradier for beginners is this. You can start small, you can learn, you can practice responsible position sizing, and you're not locked into something that won't scale with you. If you're serious about learning to trade, not gambling, not guessing, but actually building skill over time, you need a proper brokerage foundation. There's a link in the description below where you can explore Tradier and open an account when you're ready. Trade smarter, not harder. Use the right tools from day one.
Well, thank you, Lex. I appreciate that. All right, so here I just adjusted the trade because we are dealing with live markets, and right now we see Apple this option contract is trading for $5.80. So I'm going to send this. I never send it as a market. I always send it, even if I'm saying the asking price is $5.80, which is the buy price. I'm always going to put a limit on it to make sure that that is what I pay for it. Oh, we dropped down. Let's hit it. Let's hit send. Boom goes the dynamite. All right, the trade has been a success. If you see that pop up in the upper right-hand corner. So now we've filled this position. We put that trade on. And if we go back to our dashboard, we'll see that we bought Apple this morning. I put an order in to buy 100 Apple at market. And then we went in and bought a protective put. Now, remember, a lot of people might have had Apple in their account. We bought this protective put to protect us because we know that an earnings report is coming, not to mention a lot of stocks in the tech space. The Meg 7 stocks, which is Apple is involved in, a lot of those companies are going to be announcing earnings over the next couple of weeks. We're getting into the heart of the earnings season. So we're buying this. We're giving ourselves a little bit of time. We bought the 265 strike with Apple right now. We're going to say 270 to make the math easy, right? But it's 271.44. So we're just going to make the math easy. And that means from 270 down to 265, that's 5 points. Plus we paid $5.70. So that means that we're talking about our total risk to Apple over the next 28 days, because we're looking at the May 15th expiration, is going to be $11.75. And that translates into 4% of the price of the underlying stock. So I'm doing this trade saying that the most I want to lose on Apple, if the earnings report is perceived as bad, and the stock sells off, is going to be 4% over the next 28 days. Now, I don't want to do this every month, right? There's a known event. This is why we're doing it. But ultimately, like I said, insurance can be expensive on stocks. Going into, if you're doing this month in and month out, maybe you should just sell the stock, right? And find a better stock that you're bullish on. But there are some times where buying a protective put makes sense. And this could be one of those times on a stock like Apple. So I'm going to run over to the options playbook right now. So let's pop up and we're just going to look at a protected put and I'll talk a little bit more about it. Okay, so we have the options playbook site back up. And here, this is my website, optionsplaybook.com. I'll zoom in a little bit here. And I just want to talk about a generic version of this. If you see this, with a protective put, you notice that this is bullish. We have the profit and loss on the x-axis. This is actually the stock price at expiration. This is the profit and loss on the position. And once again, set up, you own the stock. We're going to buy a put at strike A, and generally the stock will be, the stock price will be above strike A, right? So in other words, the stock is trading in our instance at 270. We're going to buy the 265 protective put. But notice here, we still own the stock. We didn't sell the stock. So in this instance, you're using options as protection, as insurance, as opposed to speculation. The speculative part still comes from owning the stock. And so you have unlimited upside because you own the stock. So ideally, we'd like our put to expire worthless. We would love if the underlying stock, we're going to pay $5.70 for our put option. We would love Apple to announce earnings and go up 10 points after earnings. We would be ahead in that scenario. The put would have gave us the protection and the security to stay in during Apple's earnings. And Apple would have provided us the benefit of actually paying for our insurance. And if you think about that, very rarely does your car actually appreciate over time and cover your insurance costs. But sometimes in the options trading world, that can be the case. And it's just a very interesting strategy. And when I think about beginning options and the fundamentals of options, this is one of the strategies that a lot of people just forget about, that this can be used to enhance your stock portfolio as opposed to just using options and trying to speculate on a very short-term movement, either to the upside or to the downside of an underlying stock. So, as already mentioned by Lex, that below us is a link. Sign up for the paper trading account. You can execute those trades. It's 100% free. And if you do that, then you can trade along, right along with us. And you can follow my portfolio that I'm sending with you. And you can see, we'll go back to the well after earnings, see what happened with Apple, and we'll adjust the trade out of the trade. We're going to try to hold your hand in the basics of options and, take you along with us. And in order to do that, the best thing you can do is open up a paper trading account. It's 100% free. You don't have to fund. You don't have to do anything. You just have to open the account and you can trade along. All right, that's it for this first edition of Fundamental Fridays. We will be back next Friday, 11 a.m. Eastern time for the next edition. If you'd like to learn more and get alerts, please go to hub.tradier.com. That's where the whole plethora of speakers that Tradier sponsors is available to you. Once again, that is also free. So Tradier's really trying to hold your hand in this option trading roadmap, if you will. All right, I'm Brian Overby, author of the Options Playbook, and we'll see you next Friday for the next edition of Fundamental Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.